Previous economic models assumed that traders acted like robots.
Economists model how traders behave based on a very narrow set of assumptions, so much so that they might as well be robots. They assume that traders are very rational and very selfish, and that they compute decisions on what to buy and sell based on all available information, and that they take these decisions independently. But if traders were so automated, so rational, then why did they make such irrational decisions that have brought the financial sector to its knees?
Cutting-edge research, which combines psychology and economic theory, is revealing that animal behaviour is key to understanding financial crashes.
And studying these baboon troops is showing that the irrational decisions taken by traders is due to hardwired behaviour that goes back to our evolutionary roots, particularly behaviour that's linked to being part of a group or being part of a pack.
Animal instincts are enormously important in the city, and the whole financial market is just a product of lots and lots of people. Herd mentality is incredibly important because, especially when information is sparse and there's a degree of uncertainty, which there often is, we are hardwired to follow the crowd, particularly because if we are following the crowd and we make a mistake, we get in less trouble with our bosses than if we suddenly go it alone and make a mistake.
Following the crowd meant traders continued selling bad debts to one another until it was too late. A far cry then from the conventional economic models of how traders behave. Behavioral economics, a new branch of economic theory, has also recognized that there are other animal behavioral traits which influence traders, chiefly competition, something that these baboons know a great deal about.
In baboon life and society, rivalry is everything. Rivalry means aspirations to gain an advantage over your competitors, over your siblings, over everybody, to get to numero uno.
And getting to the numero uno is also the aim of that well-adapted ape, the trader.
I think rivalry is definitely a huge part of what's going on in the city. Remember, it's a mainly male place, the trading floor. It's like the playground. You are trying to one-up your colleagues and even more so your competitors at other banks. And that can, of course, lead to decisions that might not be logically or rationally financially sound. So you might want to show the junior that next to you that you're the big swinger, in the jungle, and that's just standard. And that can often lead to making perhaps too big a bet.
And all this adds up to irrational market excess.
I suppose from an individual trader's point of view, what he or she is doing in the limited capacity of what their job description is, probably looks fine. But of course, collectively, if you aggregate all of the traders in the world doing the things that they do, what you end up with is lunacy, which is kind of where we ended up.
And to stop this lunacy from happening again, policymakers need to embrace that raw innate emotions drive the market and not pure rationality. A strong case for banking regulation.